Hello and welcome to Thank God It's Friday. This week we are in conversation with Mark Mobius. He's the Executive Chairman and of Templeton Emerging Markets Group. Thank you for joining us, Mark.
It's a pleasure. Thank you.
Mark, so this week we had Donald Trump address the US Congress, and while he did give us a lot of details, there weren't a lot of specifics in his address to the US Congress. Based on that and based on what we're expecting from the fiscal policies and the Federal Reserve rate hike trajectory, how do you see the movement of the dollar develop going forward?
Well, I think the dollar will probably get weaker vis-a-vis a lot of other currencies around the world. As you know, many of the currencies were very weak last year against the dollar. Some of them have recovered, particularly some of the emerging market currencies have recovered. But still, I would say most of these currencies are undervalued against the dollar. And I believe the dollar will probably get weaker for a number of reasons. First of all, although the Fed will raise rates, inflation will probably be ahead of those rate rises. That's number one. And number two, Trump is embarking on a big spending program, not only in defense, but also in infrastructure. I was very surprised by the standing ovations he was getting on almost every point he made regarding spending on defense and in infrastructure. At the same time, he got a standing ovation on tax cuts. If you combine these all together, you realize that the debt in the U.S. Must increase, and therefore rating agencies will have to take notice of these deficit positions. Although going forward, if his plans work out, he'll get more money coming in as the economy recovers. But in the short run, there probably will be a weakening of the dollar, not only because of the reasons I just mentioned, but also because he has explicitly stated the need for a weaker dollar so that America can export.
Right, Mark. We're also looking at general elections in Germany, Netherlands, and France this year. Should the incumbents not get elected, what is the chance that some of these countries will want to move back to their old currencies? And in that case, does this also signal more weakness for the euro going forward?
I think the abandonment of the euro is a very, very unlikely scenario. The euro has had such benefits throughout the European Union that I don't see that changing anytime soon. Of course, individual countries may decide to opt out of many of the European Union mandates and legal conditions that they've made. But I doubt if the European currency will go by the by. This is quite unlikely.
Mark, we've also seen commodities, especially industrial commodities, run up quite a bit over this last year. Based on the demand and supply situation, how are you reading commodities? And of course, based on that, how are you reading these stocks related to the commodities?
Well, as you know, for the last 3 years, commodities up to the end of last year, commodities were doing very badly. We saw prices, most commodities going down. But now we've seen a recovery. Some of these recoveries have been quite amazing. For example, from the very low point, oil has gone up by about 100%. So we've seen a big recovery, but I don't think you're going to see big increases in percentage terms going from here. We'll probably have a sideways movement in commodities. And you must remember that although demand may pick up, there won't be a big surge coming out of China in terms of demand. And also, even the U.S., considering the infrastructure spending, that demand will be good, but it won't be enough to move the needle in terms of prices for commodities.
Mark, so we know that you look at emerging markets very closely. How would you rank these emerging market countries, and in what order would you put them in preference?
Well, we have to start with Asia because Asia is the fastest growing region. And of course, China and India are both growing at 6-7%. And we can't ignore that kind of growth. Of course, markets are different. They behave differently than the economic growth numbers. But there's still many bargains in these markets. Vietnam stands out as a particularly interesting area in Asia. If we look at Latin America, you'll see that Mexico, Brazil, Argentina are outstanding opportunities, and we would look at those areas. There is reform taking place in South Africa, which looks good, and the currency is very undervalued at this stage of the game, so that would be another area I would look at. So these would be the highlights, I would say.
Mark, you also highlighted some of these South American countries like Brazil and Mexico, and if I'm not mistaken, you have increased your allocation to these countries. Can you tell us a little more about why you find these destinations more appealing right now?
Yes, in fact, I just returned from Brazil. I was there 2 days ago in Brazil. It's very, very interesting to see what's happening. You've heard about the Lava Jato scandals. The scandals have reached way up to Brasilia into the parliament. Many of the parliamentarians are being charged with corruption. So these corruption investigations are introducing a tremendous amount of reform in that country, which is going to pay off in a big way. The government is moving very quickly to induce investment, both local and foreign investment, because they realize they don't have the money to spend to do what they need to do. And that's very, very good news, because it'll mean more efficiency in the economy. So I would say Brazil is at the top of the list, followed by Argentina. Again, the new government in Argentina is making many good reforms, and the economy will do good going forward. Mexico, although you have this problem with Trump, the wall, and all these other charges, the fact remains is that Mexico and the U.S. are highly interdependent. It'll be very, very difficult to break those ties. And we believe, given the bad news about Mexico and the depressed prices for both currency and stocks, there are many good opportunities there.
Right, so I'm going to shift focus to India now, and my question is that we are looking at lifetime highs, at least as far as the benchmark indices are concerned. They're within striking distance. So is the bull run intact for India, or can we expect some time-wise correction before we can see Indian benchmarks move up to higher levels?
There's no question that we're in a long-term secular bull market for India. However, we also must realize that in any bull market there are substantial corrections. In these corrections, you often scare people, the people get out too early and they give up. But the fact remains that India is in a long-term secular bull market. So I believe that we have to have positions in India, particularly in the small and medium-sized companies, although there are many great companies among the large caps as well.
Right, Mark, some of these Indian benchmarks trading at around 20 times for a price to earnings. Well, if I were to compare India with destinations like Thailand and Indonesia, I believe that you would prefer Thailand and Indonesia. At what levels would India start being a little more appealing, at least when it comes to valuations?
I wouldn't say we compare Indonesia or Thailand to India for one very simple reason. India is moving up very quickly on the technology spectrum. If you look at the tech stocks, whether it be internet stocks, whether it be outsourcing stocks, and so forth, they do sell at a higher multiple in the near term, if you do, let's say, a one-year projection. But over a 5-year term, many of these stocks are growing at a pace which make them very cheap. So we have to be very cautious about current price earnings or cash flow numbers. They may be a little bit misleading in that sense.
So if I were to leave the technology space out, what are the other areas in India that you would see an opportunity right now?
Well, given the fact that the economy is moving at this pace, and given the fact that there has been a temporary slowdown because of this currency problem, I would say the banks look interesting because we do want to get exposure to the economy as a whole, and the banks are the best way to do that.
Right. And areas that you'd like to absolutely avoid when it comes to India?
I wouldn't say we would avoid anything except companies that may be in the construction sector because, as you know, there are going to be problems in that sector going forward. And not only because there's no demand, there's plenty of demand. It's not a problem, but the problem is the intergovernment relations between the construction companies and government regulations could create real problems for that industry.
Right. So my final question for this afternoon, Mark, is to do with investment philosophy. We have a lot of young users and viewers on our Facebook and Periscope. And that brings me to the question is, if you'd like to tell us about 3 or 4 investment mistakes that young investors can avoid going forward.
Well, the first thing is to think short term. If you're thinking short term, you're bound to make big mistakes because there are things that are happening on a daily basis which can be very misleading. The second thing is that don't believe what you read. Check out whatever you read on the internet or in the newspapers to see if the facts are correct. Many people are misled by what they hear or read. That's the second thing. The third thing is to make a commitment to a long-term program of investment. Don't think about making a quick profit. Think about making a profit in a 5-year time frame. In this way, you'll probably make much wiser decisions.
Mark Mobius, it was a pleasure speaking with you. Thank you very much for your time.
Thank you.